How confidence became the greatest risk. It didn't begin as arrogance or excess, but as quiet reassurance built slowly over years of consistency, discipline, and repeated success that seemed to validate every prior decision. Confidence grew not from bold wins, but from the absence of failure, from markets that repeatedly rewarded patience and punished doubt. To understand why confidence itself became dangerous, we need to separate conviction from certainty, because conviction adapts when conditions change. Certainty assumes they never will. For a long time, confidence was rational. Strategies worked. Risk controls held. Drawdowns were shallow and brief. Every setback felt temporary. Institutions learned to trust their frameworks. Models grew more sophisticated. Data sets expanded. Forecast ranges narrowed. Success reinforced process. Process reinforced belief. Belief hardened into expectation. Markets rewarded this mindset generously. Volatility stayed low. Liquidity remained available. Intervention arrived whenever stress appeared. Each rescue strengthened the lesson. Downside was manageable. Recovery was reliable. Stability felt engineered. Confidence spread across strategies, across asset classes, across geographies. Different approaches reached the same conclusion. Risk was no longer something to fear. It was something to calibrate, something to price, something to manage precisely. Gradually, margins thinned, leverage increased, positions grew larger, all justified by experience. After all, uncertainty had been confronted before. Crises had been navigated. Systems had held. What was missed was a subtle shift. Confidence was no longer responding to evidence. Evidence was being filtered by confidence. Warning signs appeared, but interpretations softened them. Anomalies were framed as noise. Structural changes were labeled temporary. Confidence didn't silence doubt. It postponed it. The market environment encouraged this delay. Low rates compressed risk premiums. Abundant liquidity reduced consequences. Time seemed forgiving. But confidence has a threshold. Beyond it, adaptation slows. Flexibility narrows. Assumptions multiply. The reveal begins here, not with losses, but with the realization that confidence was no longer protecting against risk. It was manufacturing it, quietly, systematically, across the entire system. As confidence deepened, decision-making subtly changed its tone, even though no single action appeared reckless or out of bounds at the time. Risk was still discussed, still measured, still reported, but it no longer carried emotional weight. Scenarios were reviewed, yet rarely challenged. Stress tests were run, yet comfortably passed. Outcomes that once felt improbable were quietly removed from consideration. Confidence reshaped incentives. Caution felt inefficient. Hesitation felt outdated. Speed and scale felt justified. When positions were increased, it was framed as optimization. When leverage rose, it was framed as efficiency. When correlations tightened, it was framed as coincidence. The system rewarded alignment. Those who questioned consensus appeared conservative. Those who embraced it appeared competent. Over time, dissent faded, not because it was wrong, but because it was inconvenient. Markets reinforced the lesson. Every drawdown recovered quickly. Every shock was absorbed. Every disruption became an opportunity. This created a dangerous feedback loop. Confidence reduced perceived risk. Reduced risk justified larger exposure. Larger exposure increased dependence on stability. Stability, in turn, became an assumption rather than an outcome. As a result, contingency planning weakened. Buffers thinned. Optionality shrank. Confidence didn't eliminate risk. It concentrated it. What made this phase difficult to detect was its logic. Nothing felt irrational. Nothing felt excessive. Everything worked, until it didn't. Early signs of strain appeared as anomalies, movements that felt outsized, reactions that felt abrupt, correlations that lingered longer than expected. But confidence reframed them as temporary distortions, short-term noise, transitional effects. The possibility of regime change remained theoretical, acknowledged but not acted upon. Confidence had done its job too well. It had convinced the system that adaptation was unnecessary, and that belief would soon be tested, not gradually, but all at once. When conditions finally shifted, confidence did not disappear. It hesitated, and that hesitation proved costly. Initial responses were measured, positions were adjusted slightly, exposure was trimmed at the margins. The core assumptions remained intact, but markets were no longer forgiving. Volatility lingered. Liquidity responded unevenly. Recovery took longer than expected. Confidence, built for continuity, struggled with uncertainty. What had once been a guide became a delay. As pressure increased, the system revealed its rigidity. Risk limits were approached simultaneously. Strategies that once diversified began to align. Responses converged. This was the full conflict. Not fear, but overconfidence meeting reality. Attempts to regain control accelerated instability. Small adjustments moved prices. Hedging amplified moves. Rebalancing deepened drawdowns. The system learned, too late, that confidence cannot substitute for flexibility. Belief cannot replace capacity, and certainty cannot absorb surprise. Decision makers face a narrowing set of options. Act decisively and risk overreaction. Wait patiently and risk irrelevance. Either choice carried cost, because time was no longer neutral. What once felt like control now felt like exposure. Models updated after damage occurred. Signals lagged behavior. Confidence, which had once aligned incentives, now synchronized risk. Everyone saw the same threats. Everyone responded the same way. At the same time, the market did not punish boldness. It punished sameness. This was not a failure of intelligence. It was a failure of humility. The belief that experience could outpace change, that history could anchor the future, that confidence could outrun adaptation. The build-up reached its peak here, in the recognition that confidence had become the system's most fragile point. And once that recognition spread, the unraveling became inevitable. The climax arrived not with panic, but with clarity, as markets finally exposed how much depended on confidence remaining unquestioned. What broke was not strategy, but belief. Once confidence cracked, behavior changed immediately. Positions were reduced not because losses demanded it, but because assumptions no longer felt safe. What had once been held through volatility was now reassessed through uncertainty. The resolution unfolded slowly. Risk was redefined, not as fluctuation, but as dependence, not as drawdown, but as fragility. Frameworks were rewritten, buffers widened, optionality regained value. Confidence was replaced with conditional trust. This story matters because confidence will always return. Markets reward it, systems encourage it, success depends on it. But confidence must remain elastic, able to bend when conditions change, able to absorb doubt without collapsing. The lesson is not to eliminate confidence. It is to discipline it, to ensure it does not silence signals, to ensure it does not erase humility. Every cycle teaches us quietly that certainty grows fastest just before it is tested. That experience can become inertia. That comfort can become exposure. Confidence is not dangerous because it is wrong. It is dangerous because it feels complete. And when it does, adaptation slows, risk concentrates, and systems become vulnerable to the same surprise. Sometimes the smallest shift in perspective becomes the beginning of a new future. How